My name's David Page. I'm Managing Director of Financial Affairs, and I would like to welcome everyone who's joined us on our webinar today. Hopefully there's a little bit more optimism around this morning given our continued low case numbers and the commencement of our staged exit from the current lockdown. It's a particularly good weekend for Victorian sport. We had the Vixens winning the Netball Super League, Geelong and Richmond and the Melbourne Storm reached their respective grand finals. So we wish all the Melbourne sides the very best next week. We're pleased this morning to have Alan Evans from Magellan Financial Group join us today. Alan's got a wealth of experience in the financial services sector and has spent the last decade at Magellan. Magellan have consistently demonstrated an ability to identify trends and investment themes, and they're a prominent voice in the investment community. With so many disruptions occurring in 2020, this webinar presents an excellent opportunity to hear from Magellan about their views on what the future looks like. The format of today's presentation is that Alan will do a short presentation, and then what we'll do is follow that by some questions and answers. So you'll see at the bottom of your screen there's a Q&A box, and we welcome questions as we're going through the presentation. We will attempt to answer all the questions, but if we don't get to them all, we will get to your question offline. Please be aware that the presentation today is general in nature and doesn't take into account individual circumstances. So please speak to your advisor if you want to understand how this applies to you. So Alan, thanks again for your time, and without holding the presentation up any further, I'll hand over to you.
Thanks very much, Dave. Really appreciate the opportunity to present to your clients today. It goes without saying that, we're certainly in unprecedented times, and this is very different from any other economic event, certainly in my lifetime and for most of us in our living memory, because what you have is you have science and economics colliding into one. It is very different from a GFC type of event, which was an economic event, which we knew was caused because of a credit crisis. So you understood what the ramifications of the credit crisis was. You understood what policymakers, that's governments and central banks' response to the credit crisis was. And then you were able to build or construct a portfolio based on those knowns. Which stocks do I need to avoid, and which stocks am I still happy to own in a portfolio? This is incredibly different because you don't really know what the economic outcomes of this is going to be, because it's linked back to health outcomes and COVID. And it's very fluid and it's changing every single day. So you will find it very, very difficult for anybody to say, what does the world look like in the next 6 months? Because it's really linked to what happens from a health point of view. Do we get a vaccine for this virus? How quickly will the vaccine be with us? How quickly will we be able to start to immunize people around the globe? How quickly will economies open up? So let me demonstrate how COVID has an impact in terms of the economy by just going through this simple equation. So for those people who have an economics background, you'll understand what this equation is. So this equation is looking at a country's GDP. So a country's GDP is the economic heartbeat of your economy. So when GDP is rising and strong, it means your economy is very healthy and strong. When GDP is falling, and when you have 2 consecutive negative quarters of GDP growth, it means that your economy is in a technical recession. So what's GDP made up of, and why is it important to look at GDP as it relates to the economic consequences back to COVID? GDP equals consumption, and consumption's us. So consumer consumption makes up around about 70% of the economic output of a developed country like Australia or the US. So when the consumer is happy and they have a job and they're earning income and they're confident that that income will be around next week and they're consuming, it's like a steroid injection to an economy. So we do a majority of heavy lifting in the economy. So as I said, what gives somebody the ability to consume? Well, for most of us, the ability to consume relates back to, do we have an income? Do we have a job? So if you have a job and you're confident that your job, that you'll have that job next week or next month, you're likely to go and, buy that TV or go on a holiday, etc. If, however, you've lost your job or your job has been furloughed, so if you're on JobKeeper, then you are very unlikely to be consuming to the level that you once were, pre-COVID. So the key really is, in terms of the economic consequences with COVID, is how quickly will the consumer come back and start to consume? And that's a really big unknown, again, because it's tied back to how quickly we get a vaccine for this virus. And let's think about maybe an easy scenario to put this in some sort of perspective about the importance of consumption. Normally, every day when I'm going into the office in the city, I stop off at a coffee shop in St Kilda and I buy a coffee. Now, let's say that there are 350 of me's that do exactly the same thing every day. So 350 people going in and buying a coffee. Now, that coffee shop has or had 4 people that were employed in the coffee shop. So I go in, I buy my coffee, and and maybe a slice of toast, etc. So they have a cook and they have someone behind the counter, etc. Now, let's say that where we are now, that only 50 people are going to that coffee shop because more people are working from home. So I'm no longer going into that coffee shop. So instead of 350 a day, it's 50 people. So the coffee shop then says, well, look, we can't actually have 4 staff here. We can only really have 1 staff member, to make this economical for the coffee shop owner. So they either permanently reduce the staff or put them on JobKeeper. So those 3 people that have either been permanently made redundant or are on JobKeeper, they then say to themselves, well, look, I can't really afford to have my kids in childcare anymore. I'm going to take my kids out of childcare. So the childcare numbers go from 100 kids down to 25 kids, for argument's sake. And the childcare centre then says, well, we can't really have 3 staff anymore. We need to reduce our staff to 1. So by just that one transaction, buying a single coffee with 350 odd people, has a big multiplier in terms of other people's ability to consume, and therefore other people's ability to maintain their job. So one person's consumption is another person's income. That person's income is another person's consumption, and you get a very big economic multiplier. So the real big key here is, how quickly does the consumer come back? And that's really related back to how quickly we open up economies and people get their jobs back. To continue on with this, what makes up GDP? So GDP equals consumption, GDP equals plus investment, and investment is business investment. And certainly in Australia, the budget is trying to encourage business investment with the write-offs, the 100% write-offs. GDP also equals government spending, the G part. And this is very, very important as well in terms of what does the world look like from here? Because when the consumer leaves the GDP mix, like we've had here in Australia and the rest of the world, because jobs have been furloughed or simply jobs have been lost, governments have stepped in a very material way to fiscally pump prime the economy. So we've done it here with JobSeeker, JobKeeper, and the new JobMaker program, which the federal government announced in their budget. In the United States, they did what the Labor Rudd government did back in the GFC, in that they gave every adult above 18 years of age a cash injection of $1,200. They gave them that cash so they'd start to spend it in the economy. So governments have stepped in to pump prime the economy with government spending and fiscal spending, so the economies don't fall into cardiac arrest or don't go into cardiac arrest. Certainly, if you didn't have that level of fiscal stimulus by the federal government here in Australia and also in the US, our economy would be in very dire circumstances currently. So the key really here is how quickly will the consumer come back and start consuming, and what will happen when the government stimulus is taken out of the economy and how quickly that will have. So you've got two real competing criteria here that you need to focus on. And again, they both relate back to how quickly we get a vaccine for this virus. Just to finish this equation, so the GDP equals consumption plus investment plus government spending plus exports minus imports. If you're exporting more than you're importing, that's really positive for your GDP. So if we go on to the next slide, we put this slide together back in February of this year when COVID was really starting to gain momentum. And we look at the world in terms of probabilities. And when we put this slide together back at the end of February, we said there's 4 likely scenarios that are likely to roll out because of COVID and the subsequent shutting down of economies. And we weighted these scenarios equally back then. So 25% probability that either one of these scenarios could occur. The two bookends, the V-shaped recovery and the depression, we've largely now discounted. So it is highly unlikely that we will get a V-shaped recovery in Australia or in any other developed nation in the world, simply because the damage that has been done economically is real and some of it is permanent. So even if one of these stage 3 clinical trials was successful, there's currently 6 stage 3 clinical trials for a vaccine. If one of those was successful and we had a vaccine towards the end of this year and people started to get vaccinated early next year, you are unlikely to see the economy snap back very quickly in that V-shaped type. And as I said, the reason being is because some of this unemployment is now permanent. If I walk around my local suburb, within a K radius of my house, I counted the other day, there's over 24 shops that are for lease, so they're shut permanently. So very unlikely you will get a V-shaped recovery here in Australia or in the US, despite the huge amount of stimulus that's been thrown at this issue. You are seeing a V-shaped recovery in China. And that's simply because the way that they've handled this health issue is very different to the way that we've been able to handle it here in Australia, or for that matter, any other developed country. They physically locked down a city of 13 million people in Wuhan and essentially said, if you leave your house, the consequences will be pretty unpleasant for you. So people essentially abided by the rules, and they tested 11 million of those people within a month. They also forced every person that has a mobile phone to download the contact tracing app. And that tracing app color codes you every day. So green means go about your business as normal. Red means is you need to stay quarantined. We've found a link to someone with COVID. So the way that they've handled the health crisis is very different to the way that we've been able to handle it here in Australia or other developed nations. So V-shaped recovery off the table here in Australia and also in the US. The depression we've also largely discounted to zero. The depressions are caused predominantly by policy errors. So if we go back to the Great Depression as perhaps our case study, the Great Depression was caused because of policy errors that happened on 2 fronts. First of all, the central bank, the Federal Reserve in the United States, didn't step in to essentially guarantee the liquidity of the banking system. So the banking system completely collapsed. There was only a certain amount of money in the vault. Once that money got taken out of the vault, that was it, game over. The banks closed their doors. So the Federal Reserve at the time was only 5 years old. It was only quite a young organisation, and they didn't step in to guarantee the liquidity of the credit system. This time around, the central bank in the United States, the Federal Reserve, and also the RBA here in Australia, stepped in very quickly and very aggressively to guarantee the liquidity of the liquidity system. And that's incredibly important, because if the liquidity wheel seizes, the whole system collapses in and of itself. And if you refer back to the GFC, we were literally a minute to midnight of the whole system completely collapsed because the liquidity wheel started to seize. And at the time, thankfully, Ben Bernanke, who is acutely aware of what would have happened, because he's actually a professor and he's arguably the most preeminent person on the planet in terms of the cause and impacts of the Great Depression. So he stepped in with the Federal Reserve to guarantee the liquidity system. And essentially what the Federal Reserve did this time around in the US is they dusted off the manuals that Ben Bernanke and his team put in place the policies that they put in place in the GFC, and they stepped in very quickly. Governments also stepped in a very material way to fiscally pump prime economies. In the Great Depression, that didn't happen. So at the time of the Great Depression, Hoover was then the president. He was a capitalist, and he believed that the capital system would actually solve the problem, and clearly it didn't. It wasn't till Roosevelt got elected and he started the New Deal program, so spending money to stimulate the economy, similar to what our governments have done here in Australia and also the government in the US. So policymakers' response, both central banks and governments' response to this in developed countries, has almost been faultless. So that really takes the depressionary scenario out of the equation for a large extent. So where we are is we're in the middle. So a U-shaped recovery is a recession that lasts for 1 to 2 years. A prolonged and deep recession is a recession that goes for 3 to 5 years. So which one of these scenarios will actually occur? The answer is we don't know. Because again, it's linked back to what happens from a health point of view. If one of these stage 3 clinical trials is successful and we get a vaccine and people start to get vaccinated early next year and you open up your economies, you're more likely to see a U-shaped recovery. If we don't get a vaccine, and let's say that vaccine is delayed to mid to late next year, then you're more likely to get a prolonged and deep recession. A word of caution here, and certainly, Magellan, like everybody else on the planet, we really hope that one of these stage 3 clinical trials is successful, and people do start to get vaccinated sooner rather than later. But you've got to be careful that you don't have all your bets on black here. And even our government assumes in the budget that we actually get a vaccine early next year and the economies start to reopen in Q2 of next year. That is a pretty brave call because the vast majority of stage 3 clinical trials actually fail. So you can't guarantee that you'll have a vaccine. And if you look at HIV as maybe a reference point, that's a virus that's been around since 1980. And in 1984, the chief scientists around the world said, we will have a vaccine for HIV within 2 years. If you fast forward to where we are now, we still don't have a vaccine for HIV, despite hundreds of millions of dollars being spent on this. So it's important that you don't put all your bets on black here. You've got to be still very cautious about how you construct a portfolio, because it may be that we're living with this virus a bit longer than we've anticipated. So if we just go to the next slide now, what does that mean for Magellan and how we've constructed our portfolio? So With Magellan, we have two key investment objectives. The first and most important is to minimize the risk of a client suffering a permanent capital loss. So if we believe there are macroeconomic issues or black swan events like what we've got with COVID that will force that will perhaps mean permanent capital loss in our portfolio, we will move our strategy very aggressively to cash to put some defense in the portfolio. So you can see from December to January, we moved the strategy, from December to March, we moved the strategy from 6% cash to 17% cash. The maximum cash level we can have in this portfolio is 20% cash. The cash number in our portfolio now is about 13%. So we're becoming a little bit more confident about where economies and markets are headed. So we have deployed some of that cash, but it's still quite elevated. Now, under that number, you'll see under the cash number there, if you have a look at in June, there's a number called a CRR, and CRR stands for combined risk ratio. And think of it as a risk budget. So we cap the CRR at 0.8. So we have a very constrained risk budget in this strategy. And think about it like this, that we look at how will the portfolio perform if we have volatility in markets. So roughly the numbers are, if the market adjusts by 1% and we've got a 0.67 portfolio CRR, the portfolio should, in theory, should adjust in order of 0.67%. So we're trying to deliver a portfolio which has less drawdown risk than the market as a whole. In terms of the Magellan Global Fund, since inception of the fund, 1 July 2007, this portfolio has delivered 100% of the upside when markets are up, but only 50% of the downside. And really, that's because of this constraint that we put on ourselves. Thankfully, leading into the crisis, we had a very defensively positioned portfolio anyway. So if you had a look at that in December, 25% of the portfolio were in very defensive names. That as a percentage of the portfolio now has increased to 29%. So you can increase the defensiveness of the portfolio or reduce the combined risk ratio by increasing the cash or increasing our exposure to these defensive businesses. Let me just call a couple of these businesses out. These businesses should do very well despite what is happening, with COVID and the economic fallout as a result. 4 of these companies are US infrastructure companies. 3 of them, Xcel Energy, Eversource Energy, and WEC Energy, are US regulated power utilities. Almost the perfect businesses to be in because the regulator tells you what return on your capital investment you can actually generate from these businesses. So your earnings are regulated by the regulator. If your earnings drops below a certain point, the regulator allows you to increase the price that you can charge for the electricity. So if you have customers that can't pay their bills, etc., and you're losing revenue, you can increase the prices for the rest of the customers in there to ensure that you have a consistent regulated return. And we're all still using power, working from home, etc. So extremely good businesses to be in. We own a company called Crown Castle, and Crown Castle is a business that owns very large telecommunication towers in the United States, and they charge the telcos to put their dishes on those towers. So that business is more about big data. So it's estimated that we will actually double the amount of data that we consume in the next 2 years alone. So, which means that the telcos need to have more dishes on those towers. So that's been a very resilient, robust business. That stock's up 30% year on year. We own a business there called Reckitt Benckiser, and Reckitt Benckiser is probably not a business that is familiar with most people. Reckitt actually owns some brands that will be very familiar to you all. It owns Dettol, it owns PinoClean, It owns Strepsils. It owns Finish dishwashing product. It owns Mortein. It owns Tylenol. It also owns the largest disinfectant company in the United States called Lysol. Now, we liked this business before COVID. We actually like it even more because we're all disinfecting everything to within an inch of its life. So it's been a very good business to have in the portfolio. We own a business called Novartis as a defensive portfolio stock. Novartis is a Swiss-based pharmaceutical company. The great thing about pharma is that it still performs extremely well despite COVID and the subsequent economic fallout, because the drugs that these businesses make are life-extending drugs. So you don't just wake up because you have economic turmoil and decide that you're going to stop taking your heart medication, for argument's sake, because obviously the consequences are pretty extreme. So revenues of these businesses is very robust. Rounding out the stocks that we have in here, Nestle, which is arguably one of the most defensive, resilient consumer businesses on the planet. We have Pepsi in that bucket as well. Seems a bit odd that you'd own Pepsi in a resilient part of your portfolio, because you think carbonated fizzy drink hardly seems resilient. Pepsi's actually around 50% of their revenue comes from snacks. So it's actually one of the largest snack companies in the world. And in a world where we're all working from home, if you're anything like me, my trips to the pantry have increased dramatically, as has my waistline. So good business to have. A couple of other businesses that I'll call out here. Our exposure to resilient tech, you can see as a percentage of the portfolio, we've actually increased our exposure to those businesses. Extremely good businesses to have in a portfolio. So SAP is the fourth largest software business in the world. Microsoft is the largest software business in the world. The software that these businesses actually manufacture are mission critical to the functioning of a business. So, Magellan, we just don't say, look, there's a economic crisis, we're going to turn off Microsoft. If we turn off Microsoft, our business doesn't operate and function. And the thing about these businesses is they're subscription based. So you pay for a monthly subscription. So it's almost like an annuity revenue stream from these businesses. The other thing that's really important with these two businesses is they both have very large cloud divisions. So SAP, about 35% of their revenue comes from cloud. Microsoft, it's about 20% of their revenue. They own Azure, but it's growing at 30% per annum. So there is a big move happening around the world from off-premise service to cloud-based servers. And talking to our head of IT, Magellan moved from on-premise service to off-premise service around about 2-3 years ago. So simply when we made the decision on the 13th of March that everyone worked from home, we just rang our cloud provider and said we need more capacity. So what you've seen as a result of COVID is the move to off-premise cloud services actually started to gain considerable momentum. Tencent and Alibaba are two China stocks. Tencent is the largest online gaming business in the world. So I don't mean here online gambling. If you have teenage boys anywhere in your life, they're all addicted to a game called Fortnite. Fortnite is a game that Tencent own. And in a world where we're actually stuck at home and we're looking for entertainment, it's a great business to be in. Alibaba is the Amazon of China. It's also the Netflix. It's also the Google. It's also the Apple streaming music companies. It's the Uber Eats. It's an incredibly privileged and powerful business. Again, being a perfect business to be in. We've reduced our exposure underneath that to our restaurants. Still very good companies, but restaurants are still in some places are physically shut down, so that has an impact on earnings. We've reduced our exposure to cyclical tech companies. Alphabet, Google, and Facebook are the two largest advertising companies in the world. When you are in a situation like we are, when you're in an economic crisis and businesses are forced to interrogate their profit and loss statements, the first thing that they reduce is advertising. We had a meeting with a gentleman by the name of Barry Diller, who's the chairman of Expedia. And Expedia had budgeted to spend $6 billion on advertising this year, predominantly on these two networks, Google and also Facebook. He was telling us that they'll be lucky to spend $1 billion this year. And if you think about it intuitively, you know, we're not going onto Google and searching Fiji holidays because we can't go to Fiji. Visa and MasterCard seems a little bit odd that we reduced exposure to those businesses because we're all using, you know, more cashless methods to pay for our goods and services. Long term, these businesses will be material beneficiaries of what's happening as a result of COVID, and I'll explain that in a minute. But about 20% of their revenue comes from cross-border transactions. That is, when you use your Visa or MasterCard overseas, they make out like bandits. It's the highest margin part of their business. So in a world where we're not traveling, that's clearly 20% of their revenue that's at risk. Longer term, these businesses will be huge beneficiaries of COVID because we are now shopping more than ever online. And if you're looking, you know, at Australia, parcel deliveries here are up 80% this year. And whilst that will certainly come down once we, you know, can physically go to, you know, Chadstone or the like, once people have made that move and they're familiar with that platform, you know, there's going to be a lot of people that stay on that platform. So if you look at the US, their online as a percentage of total retail has gone from 11 to 16%, and it's only just dropped back by a couple of percentage points with the reopening of their economy. So all of these tech businesses will be long-term beneficiaries. So maybe I'll stop there and go to Q&A now.
There's been a couple of really good questions come through. One of them was in that last slide you showed between March and June, you I suppose increase the amount of your excess cash that you've invested into the market. Mm-hmm. Is that a reflection of a better sentiment moving forward?
Yeah. So it is certainly. You know, we are far more comfortable today than we were back in June. In that, you know, come what may, if we don't get a vaccine late this year, early next year, we're getting better with living with COVID. So, you know, the way that we actually go about life now is a lot different. So you can, you know, and hopefully in Victoria, you know, this weekend or next weekend, you know, retail will open, and that then starts to, you know, breathe life back into the economy. So the fact that, you know, we are getting better, certainly, you know, death rates around the world have actually are lower, and you know, it's the you know, people are generally surviving this a lot better than they were when we first actually started to really get the serious numbers around the world. So we're a little more confident than we were back in June, and we've deployed some of that cash. And some of that cash, we took advantage of some big mispriced opportunities that we got with some of this volatility that we've had over the last 3 months. So there was a couple of stocks that unfortunately I'm unable to disclose currently, that for us, you know, just became very, very attractive from a pricing point of view.
Yeah. And one of the things you led by just giving an explanation from an economic perspective, you know, what's happened and what your best case scenario is for the future. But one of the things we've experienced in this is I suppose a disconnect between the economy and the investment market, which I think has been confusing for investors. How do you think that's going to play out in the future? You know, will there continue to be a disconnect? Will the market continue to rise while the economy, you know, putters along the bottom?
Yeah, it's a really good question, Dave. Maybe let me just give you a bit of a reference point here about the disconnect. So three or so months ago, we had a GDP number in the US, and US GDP was down 30%. Like, that is simply breathtaking, a 30% reduction in GDP, and the market barely moved. That's kind of odd. And let me say this. So the market is forward-looking, and the market is absolutely pricing in that we will get a vaccine for this virus. So get a vaccine towards the end of this year, early next year. Economies start to reopen, and if that's the case, so if that scenario which the market is pricing in was to occur, then the market is probably right. It's probably reasonably priced. But what happens if you don't? What happens if we don't get a vaccine for this virus? That then means that the economic fallout is going to be far worse than the market's currently pricing in. And you saw this with Johnson & Johnson last week when they stopped their clinical trials. You saw that with Eli Lilly in their drug last week as well, and you start to get some market volatility around that. So if it was that none of these stage 3 trials were successful, or they start to blow out mid next year, late next year, you could easily see the market adjust very quickly and very violently. And whilst we have that elevated level of volatility that is real, and there is real potential of that, we're just not going to put all our clients' bets on black here. We're just going to remain very, very conservatively positioned until such time as we get a clearer understanding about what the health outcome looks like, and then what the likelihood from an economic point of view. And to be honest, not even the leading scientists around the world can tell you what this looks like from a health point of view, because it's just so unknown.
Yeah. Just a slight change in tack, something that's very topical at the moment. And I watched a presentation from your chairman, Hamish Douglas, the other day, just in respect to the US election. And I know he's got some interesting thoughts there. So maybe you'd like to share those with the group.
Yeah. So if it is that the Republicans win, Trump wins, then not a lot changes. So if it is that Biden wins, and it's going to be interesting to see what Trump does. So does he contest it via the courts, which he's actually said he would do? That then puts uncertainty and volatility in markets. So that'd be the first thing I say. So let's say that the Democrats are successful and Biden wins the White House. The key here is really who wins the Senate. So at the moment, you have the Democrats that control the House of Representatives. The Republicans control the Senate by 4 votes. And of course, the Republicans control the White House. So if Biden gets the White House, they control the House, and they get the Senate, that means that potentially they can push through some change. So what you would see if they control the Senate, that Biden has really campaigned on an agenda of really 3 things: increasing the corporate tax rate. So Trump reduced the corporate tax rate in the US down to 21%, which is obviously very positive for companies. Biden is looking at increasing the tax rate from 21% to 28%. So that's important in terms of markets, because if you think about what we do as an investment manager, is we're trying to predict the future cash flows of a business, and you're trying to discount those future cash flows back to a net present value as at today. So what am I paying today for these cash flows in the future? What will impact the cash flows is a tax rate. So if you increase the tax rate from 21 to 28%, obviously your free cash flows are reduced accordingly. So on our numbers, it changes valuations of the businesses that we look at by about 7 to 8%. So you will see volatility in markets accordingly. He's also running on an agenda of health reform, so really trying to reinvigorate what the Obama administration tried to do. So to try and give healthcare to all, to the masses, to a similar system to what we have here in Australia with Medicare. And the other thing he's running on is an agenda of decarbonisation. So, that will be very beneficial for businesses that are facing that. So, green energy, or even utility companies, which might seem odd because if you're an existing utility company, you can say, how does an agenda of carbonisation help you? If you're building wind or solar farms, you need to connect that to the grid. So, if you're a utility company in that area, you need to build that infrastructure. That's actually positive for you as a utility company. So the key here is who wins the Senate. That's the focus that you should be looking on. If the Democrats get a clean sweep and they can start to push some of these reforms in, that you'll likely see some volatility in markets because of the tax rates, and also healthcare stocks will be impacted because of their healthcare agenda as well.
There's a couple of questions coming through that are asking questions about interest rates, and I might tie those into a question that I had as well, which is in regard to, we've got governments running up debt, like we've never ever seen before, and interest rates are almost at historical lows. So some of the levers that they can pull have been, taken away from them. What are the steps do you think that they will employ moving forward to try and manage this debt, and what impact does that have on investment markets?
Yeah. So let me maybe talk about low interest rates for equity markets. So interest rates, in Warren Buffett has called interest rates are the gravity on markets. And let's think about this. So if I could buy a company, and let's say the risk of that company out of 10 is 5. So if I buy the company, that's a risk of 5 out of 10 in terms of how that company will perform. And let's say the return on that company that I can deliver is 4%. Let's say over here I can buy a 10-year government bond in the US. So a US 10-year treasury is recognized as the least risky asset on the planet. So it's called the risk-free asset. And let's say again that the rate of return I could get on that asset is 4 as well. So a company, 4% return, a risk-free bond, 4% return. Which one of those investments am I going to take? I'm going to take the risk-free one any day of the week, because this has risk. Even if this company, if the return I could get was say 5 or 6, you might say, well, you know what, I'm not prepared to take that additional risk to get the extra 2% because I can get 4% risk-free here. Let's now say that company, which the risk out of 10 is 5 and risk out of 10 is 0 for the 10-year treasury, and I can get 6% here, but the government bond, the rate of return now is 1%. So 6 versus 1. The decision-making criteria is very different under those circumstances. I then might go, and it's highly probable that I would, I'm happy to take the additional risk to get the additional return. So you can see that as interest rates go down, the value of company goes up. You're more likely to buy that company to get the return, even though there's an elevated level of risk. So lower interest rates are very good for equities and valuations of equities. So that's the first point in terms of equity markets. What I would say is, I think you're going to have to be, sorry, let me actually go back a step. It is highly likely, given the economic scenario that we are in because of COVID, it is highly likely that interest rates are going anywhere soon. So, we are going to be in a very low interest rate environment for for a very long time, for the foreseeable future. So it's unlikely you'll get interest rates rising in the short to medium term. But people are assuming that it'll never happen. And that's a really big assumption to be making. Because if you go back to the economic equation that we started with, if we get a vaccine, economies start to recover around the world, jobs are created, the consumer is now confident, happy, they're spending money in the system, together with the tsunami of stimulus that has already been put in the system with JobKeeper, JobMaker, in the US as well. So all this stimulus and the economy starts to revive, etc., that's inflationary. So if inflation starts to tick up in the medium to long term, the Reserve Bank of Australia and the Federal Reserve in the United States need to actually try and keep that inflation in check, and how they do that is by increasing interest rates. So you've got to be careful that you're not making an assumption that this is how it's going to be forever and ever. Because if you do, and interest rates start to increase quicker than you are factoring in, it can hurt. You can hurt your portfolio. So it's not an issue now or in the short to medium term, but that's not to say it'll never be an issue. So you need to be thinking about it, and we're long-term investors, so we're taking positions in a company for the long term. So it's something that we're still thinking about. In terms of the government debt, at the moment, it's not an issue in terms of the increased debt load that governments are actually taking on, because their interest payments are actually lower than what they ever have been. But again, to assume that you can just keep on doing that forever and ever and it doesn't have any consequences, you might as well believe in the tooth fairy.
There's a question coming through just in regard to the increasing holding in the technology stocks in your portfolio. Does this indicate a longer term play about the future growth in this sector compared with others?
Absolutely. So it's a thematic so we've liked this thematic, the technology thematic for a long period of time, and having been invested to it, probably a decade now. And, we are really just at the starting line here. And if you think about this, so the way that we do things now is very different, and it's changing incredibly rapidly. Think about what we're doing currently. So until COVID, I never did a presentation using this type of data that we're using, the form factor that we're currently using. And this is now going to be the norm. So we're going to do a lot more of these Zoom meetings or Teams meetings, etc. The way that we entertain ourselves is forever changed. So I've got 2 teenage children, and the way they entertain themselves is they go on YouTube. So YouTube is actually owned by Alphabet Google. Netflix and these types of businesses now, they're a part and parcel of our lives. The way that we consume, the way that we buy goods and services, think of Amazon in the United States, think of Alibaba in China. So, and again, what these businesses do is that they bring new things to the platform all the time to keep us connected to the platform. Let me give you an example about that. So in 2014, Apple launched their smartwatch. So that business now, if you took their wearables business and took it out of Apple and listed it on the stock exchange in the US, it would be one of the biggest businesses in the world. So they implement different things that connect you to the environment. Think about a company like Alphabet Google. They own a business called Waymo, and Waymo is the #1 driverless car technology company in the world. So it is #1 by a country mile. So their driverless cars can drive about 6,000 miles without needing any human to intervene for any purpose. The next best is like Tesla and BMW, which is about 600 miles. So in our view, that you could have a situation, and the move to driverless cars is real, and it's happening, and it's going to be more prevalent in society. Waymo have been or got approval in Arizona to use fully autonomous cars in a 9 square mile radius. So you essentially, it's like Uber. You call up your car, it comes, and it's got no driver, and it drives you in that location. And this will roll out. So, in 10 years' time, it could be quite normal for us to get into a driverless car. So, in our view, that you could have a situation in 10 years' time where there's 2 main driverless technologies that operate, similar to what you have with mobile phones. So mobile phones, you have iOS, which is owned by Apple, and you have Android, which is owned by Alphabet Google. You could have the same in the driverless car space. So Waymo, in our view, could be, in 10 years' time, one of the most explosive businesses on the planet. So a long-winded answer to a very simple question. Yes, we, despite the fact that these businesses have grown, despite the fact that they're very, very profitable, we think there is, decades of growth to come in these types of businesses.
Just a portfolio question. One of our clients is just interested in the slide that you had up with all the stocks. Which Magellan portfolio was that you were?
That's the Magellan Global Fund.
Okay. Yeah. Thank you.
The Magellan Global, the MGG, which I know some of your clients have got, the portfolio would be very, very similar.
No worries. And we might, given that we are starting to approach, if you've got any final questions, you might get them through to me now. But just in line with everything that we've talked about today, and given that Magellan have always had very ambitious investment targets for their portfolios, has the new environment made you review those investment targets?
The short answer is no. So the investment target that we have for the global fund is, so the two objectives: minimise the risk of the client suffering a permanent capital loss. So we're running a very conservative portfolio. This is the most conservative this portfolio has been since the GFC. So we think that, despite what could occur from a health point of view, the portfolio will be, quite resilient. The second objective that we aim to deliver is 9% net of fees through an investment cycle. So think of an investment cycle as 3 to 5 years. We stand behind that. So that is, we haven't adjusted that target, and we still think it's very achievable.
Excellent. Well, we haven't had any other questions come through, Alan, so we might take that opportunity to wind things up. And just on behalf of Financial Affairs and all of our clients that have joined us today, I'd like to thank you for providing your time to us. We really do appreciate it. It's really interesting to hear the views from someone who is literally at the ground floor on the investment side. So we really appreciate your time and for delivering that today for us.
You're more than welcome, and to you and your clients, stay well and stay safe, and with a bit of luck, the next time that we see each other, it'll be in person.
Yeah, we might be in the face. And for the Richmond or Geelong or Melbourne Storm supporters out there, may your team win this weekend. It's certainly going to be, even though we can't have people around to celebrate grand final days like we normally would this time of year, I still think it'll be a good day, and we can certainly look forward to the times ahead. I'm very optimistic. So,
thanks very much for your time.
No worries. Thanks again, Alan. Take care.